Welcome back to the channel. I'm Michael Studebaker, and today we're going to be talking about some of the best tax write-offs when or if you guys decide to invest in real estate. So, if you haven't already, please subscribe, like the video, and hit the notification bell if you want to see more content on personal finance and investing. Now, let's get straight into the video. So, owning real estate is much more than just owning a cash-producing property that provides monthly profits. What makes it really unique is, against almost every other investment, is the tax write-offs associated with it. In real estate, a return could be calculated in so many different ways besides I get $1,000 per month in rent. So what makes real estate really special is that you could often make money like every month, but on paper show a loss. And this basically cancels out your tax obligation. So here are some of the tax write-offs that make real estate a phenomenal investment, in my opinion. So the first thing we're going to start talking about is deductions. So one of the most basic tax advantages to investing in real estate is the ability to deduct certain expenses relating to an investment property, such as rental, which may include property tax, property insurance, mortgage interest. You also got property management fees, you got property repairs, capital improvements or ongoing maintenance, advertising expenses, basically just like the cost to list a rental or market a property for sale. Many real estate investors choose to own and invest in real estate with an entity, such as a limited liability company or limited partnership. Doing so opens up a number of additional tax deductions relating to the operation of the investment business. For things like advertising, marketing, expenses such as mailers to find off market leads, business cards, or sign for your office, legal and professional fees such as accountant, attorney, or bookkeeper. So, business equipment too, such as laptop, printer, office desk, or phone. For office space, including a home office as well. For communication, such as internet, P.O. box, phone line used for business purposes, but make sure it's for business purposes. Travel expenses, including your vehicle mileage and parking fees. So education as well, and membership, such as an annual fee for a trade association or costs for a seminar, book, or a course, on a topic relating to your industry. Meals, as long as the meal is with the prospective or current client or partner and business is discussed. So most of the property related expenses can be deducted at face value, although some, like capital improvements, are depreciated over a period of time. Many business deductions are a portion of the expense. So for example, you can only deduct 50% of your meal expense, or $5 per square foot of your home office, with the maximum of 300 square feet. So make sure you keep good records of your expenses throughout the year so you can take advantage of the tax savings available through real estate deductions. It really helps you guys. So second thing we're going to be talking about is depreciation. So if you own a property that is being used for business, income producing purposes, like a rental property, for a year or more, you can depreciate the cost of the property over time. So depreciation is the method of deducting a property's loss in value over its expected life, which for residential property is 27.5 years, and commercial property is 39 years. In essence, it's accounting for a decrease in value from average use and wear and tear. For example, if you purchased a single family rental for 200 grand, you could deduct an annual depreciation of $7,272 each year. This is found by taking 200 grand divided by 27.5 years. You can also depreciate certain capital expenses like replacing a roof or installing a new HVAC system over a period of years. This can help provide even greater depreciation deductions on your annual taxes. So depreciation can only be used on investment properties, making it it's like a huge tax advantage available only to real estate investors. So be sure to keep track on that. Unfortunately though, depreciation doesn't last forever. When the property is sold, the depreciation is recaptured. So the depreciated amount is then regained and taxed as ordinary income with a maximum tax rate of 25%. So there are methods to avoid depreciation recapture, like a 1031 exchange. So third thing we're going to be talking about is passive income and pass-through deduction. Real estate is frequently praised for its ability to produce passive income, which is cash flow that is earned without having to continuously work for it. But passive income is often confused with passive activity. According to in the IRS, passive income is any money that is earned from rental activity or business activity in which they don't materially participate in, yet it explicitly excludes residual income earned from a passive investment such as dividends or interests from a mortgage note. So that means passive income in real estate is most commonly earned from rental income. So before 2018, the only way to offset passive income was with passive losses. But when the Tax Cuts and Jobs Act was passed, it allowed businesses who earned qualified business income, which is known as QBI, which includes rental income, to pass up to 20% of taxable income using a pass-through deduction. It's important to note, though, that you can only take advantage of the pass-through deduction if your business is profitable and not all income types qualify for this deduction, which is currently available until 2025. The fourth thing we're going to talk about is capital gains taxes instead of income taxes. So when you sell a property for more than you originally purchased it for, the profit will be taxed as a short-term or long-term capital gains, which is typically a lower tax rate than ordinary income tax. Short-term capital gains, it's basically which are properties held 1 year or less, can range from 10% to 37% depending on your income bracket. Long-term capital gains, which are property held a year and 1 day or more, are taxed more favorably, ranging from 0% to 20% depending on your tax bracket. It's a huge difference there. You can utilize certain tax-deferred or tax-free methods of investing in real estate to avoid paying capital gains. Now, these methods are outlined below. The fifth is invest tax-deferred or tax-free 1031 exchanges, named after Section 1031 in the IRS tax code. Basically, a 1031 exchange is a legal transaction that allows real estate investors to swap an investment property for a like-kind property, thereby avoiding capital gains or depreciation recapture on the sale of the property. So tax-free or tax-deferred retirement accounts There are special savings accounts, like a health savings account, HSA, or special individual retirement accounts, IRAs, like a solo 401k, SEP IRA, or a self-directed IRA. That act allows you to invest in alternative assets, including real estate, tax-free or tax-deferred. So annual contribution limits, though, vary depending on the type of account you open, and there are different requirements prohibiting who and what you can invest in with each account. However, this can be a great way to avoid taxes, but still invest in real estate. Opportunity zones. So opportunity zones are over 8,700 designated census tracts, making up some of the most rural and distressed areas of our country. So to stimulate growth in these areas, a new tax incentive was rolled out as a part of the Tax Cuts and Jobs Act, which allowed investors to roll qualified capital gains into an opportunity zone, fund, thereby deferring capital gains or paying no capital gains depending on, how long the investment is held in the fund. So since this is still a relatively new opportunity, changes and further clarification of the rules and requirements of this program are being made regularly and just adjusted. So that's about it, guys. So I hope you guys enjoyed the video and found it helpful. If you did, please subscribe, like the video, hit the notification bell if you want to see more content on personal finance and investing. I hope that all of you guys invest or who are investing in real estate will be able to use some of these tax write-offs. And for those of you who are just planning or to get into real estate in the future, to just keep these tax write-offs in mind so you can take advantage of it and save some money. Because at the end of the day, I just want to see everyone succeed, Remember, consistency is key and hard work pays off. Thanks, guys. I'm Michael, and I'll see you guys in the next video.